Welcome, everyone. I'm Chris Clow, editor and reporter with HousingWire, sitting in for Sarah Wheeler. Today on HousingWire Daily, lead analyst Logan Mohtashami discusses the rate environment and where the country needs rates to be in order to sustain growth in home sales. Logan, welcome back to HousingWire Daily. Appreciate the chance to talk to you.
It is wonderful to be here, and we both got to experience a very wonderful movie this year because we're both Wolverine fans. And of course, I got my name Logan from Wolverine when I became an American citizen. They asked me if I wanted to change my name, and I said, yes, change it to Logan. And I was like, and they ask you always, they say, you have to give the reason why you changed your name. And on the record books, it says Wolverine, X-Men, so we both got to enjoy that in this crazy year.
Oh, yeah. And also, I mean, it's a good choice because you are the best there is at what you do. And
I'm not very nice at what I do either. Yeah. So that's kind of the reputation. Of course, a lot of people know me for challenging people to live debates. And pretty much most of them say no. And I call them cowards and frauds. So there's a definitely Wolverine vibe in my social media. And there's unbelievable relentlessness in going after some of these people. So yeah, there is a kind of a Wolverine theme to my economic discussions at times.
I mean, sometimes I would imagine that relentlessness is necessary, but in this case, you're going to pop your claws to talk about the data that's sort of been gathered over the last couple of years in terms of what we've seen with rates and where we're going. What did you want to say about that?
So this discussion is, what we're going to do is talk about what mortgage rate level do we need as a country to grow existing home sales. Now, the builders have been able to grow sales using sub 6% mortgage rates. But here, I think what I've seen starting at the end of 2022, and we have to remember at the end of 2022, mortgage rates went from 7.25% down to 6%. It gave us 12 weeks of positive forward-looking data. That data line transcended into an extra 500,000 home sales, and then rates went up, and then that ended. Last year, mortgage rates went from 8.03% down to 6.63%. It only gave us 8 weeks of positive data, and then rates went up. Rates went up at an elevated level. But with 2024 data, counting what we saw last week, the last 18 weeks, 12 of them were positive, 1 was flat, 5 was negative. And this is a non-seasonal time frame. We can actually be able to grow sales if mortgage rates just stay between 5.75 and 6.25. And there's enough data to warrant that because whenever we get near 6%, we have this series of constant positive weekly data. The last 3 weeks, we've been positive year over year. This way, we don't have to think that, we need 3% mortgage rates or 4% mortgage rates or even 5% mortgage rates. We can grow sales from this historically low level by just getting there. And that is a little bit more workable for me because I can't really forecast below 5.75% mortgage rates unless the labor market gets weaker, the mortgage spreads get better, and the Fed gets a little bit more dovish. So it's encouraging to see what just happened. Of course, rates just shot back up again, and we're a little bit over that 6.25 level now. But they're starting to get a mix of data, putting them all together since the end of 2022, that this is somewhat workable. And it does show why the home builders have been able to grow sales since the lows of 2022. When mortgage rates get below 7, they have the ability to pay down more rates and get into the 5s, in some cases the 4s, and they're growing sales right there. And just to give everyone a kind of perspective, new home sales are over 700,000 right now today. Existing home sales are still trending roughly around 4 million. New home sales would have to be under 300,000 today to match how low existing home sales are, right? So there's a huge divergence in the marketplace. One is at record low levels of sales when you adjust it to the workforce. The other has been growing noticeably from the lows of 2008. So it's there. We just need lower mortgage rates to stick. And that's the frustrating part, that we actually get all this movement, but every time it happens, rates pop up, and it kills the steam. So it does also explain why we have near 5 million total home sales. I mean, we're just talking about an injection rate of 500,000 home sales on top of the 4 million we have. And then, you add the new home sales into the equation. So I found this to be very encouraging because you could only test this stuff live when you have a series of data. And I've always said you need about 12 to 14 weeks of positive trending purchase application data for this to work. And we've only got that when mortgage rates have gotten near 6%. We've never really had it break under 6% yet. But just getting that to that level and having it stick would change it, primarily because we're working from the lowest levels of home sales ever. So using that low bar, you can grow sales from here. So I'm hoping as time goes on, the labor market does get a little bit softer and rates come back down there. And if it could just stick there, I think we'll be okay. I mean, it doesn't mean we're going to get back to pre-COVID-19 existing home sales, but it does give us an ability to grow sales, which we haven't been able to do really in any kind of consistent fashion. We get these 1 or 2 month pops, and then mortgage rates go up, sales come back down. We just hover around this 4 million level. And I always like to bring back the early 1980s here, because the early 1980s, we had the same backdrop. Affordability was worse. Mortgage rates were very elevated, but as mortgage rates started to come down, 2.5% plus, boy, sales started to grow. And it started to grow noticeably back then. So we have the backdrop. We have a rate target that we need. We just got to get there and have it stick.
Sure. I saw it suggested recently from your favorite source of housing data, social media, that buyers right now seem to be impatient because they're waiting for a rate that may not exist. Does that actually translate, based on what you've seen, into like lost potential for home sales, or does that stuff kind of come out in the wash?
This is kind of how I look at it. Because of qualified mortgage, it's not just the rate. Prices have been still rising since 2022. So you have to take the whole equilibrium of housing costs. And I think there's a lot of people who just don't qualify. I mean, mortgage rates for them got to get down to 5.25 or 4.75 for it to even get a pre-qualification letter. But then there's the people who are just kind of, I really like to move, but I really just want my mortgage payment to be X. And I think those are the marginal home buyers that we have lost. Partly they can't qualify, or partly they feel more comfortable if they have an X payment. And just to give everyone some perspective, historically, in the past decade, the season or the decade high in total home sales were 6 million. We've lost about 1 million marginal home buyers. So that core home buyer is still there, but that marginal home buyer isn't. Now, existing home sales broke out before COVID hit us, but can we just get 500,000 to 750,000 more home sales? We can, but it does require rates to get to a certain level and stick, because I think when people feel comfortable that rates aren't going to spike on them, then you can plan to list your house and look for the homes and all the process that goes into it. But when we're working on this edge here on back and forth between 6 to 8%, 6 to 7%, it just takes some of that steam away when rates shoot up. But, I was so encouraged to see that even with home prices where they are here, just getting down to 6% created that positive demand curve. And if it didn't, we wouldn't be having this conversation today. But the fact that the last 18 weeks have been majority positive, and it's hit my rule about 12 weeks of positive data, then that'll be good. But in regards, it's something to look forward to, because at some point in the future, the Federal Reserve will talk about housing. They're not going to have existing home sales trend at the lowest levels ever for forever. And since we're not that far away from getting something like that, I feel more positive going out in the future on this concept, because the Fed is cutting rates, because the labor market has gotten softer, and because we're not really producing a lot of housing, right? Everybody talks about we need to produce a lot of homes. You're not going to get a mass construction with rates this high. It's just not going to happen. I mean, before rates fell, I mean, housing starts were at recession lows, permits were at recession lows. The backlog is going to be done soon. So there becomes a point where you become so restrictive that by the time you charge up the kind of new permits and get things done, we're already going to be behind in production of housing. And this is what happens in every kind of cycle. But here, you don't even really need much. You just need to get to a certain level and have it stick.
Compared to where we are as we're speaking, is there any short-term indicators that could drive rates down by another quarter point over the next, let's say, 6 months?
So we are talking on Thursday morning here. By the time this comes out, this will be the holiday Monday. Jobless claims had a really big spike. Now, jobless claims historically always have big spikes around hurricanes. We're going to have about 3 to 4 weeks of hurricanes into the jobless claims data. I always say that the labor market overrides the Fed. So let's do a hypothetical. Let's say the last jobs report did not actually beat estimates. The last jobs report came in at 75,000. And wage growth was down to 3.4%, and the unemployment rate got up to 4.3%. The 10-year yield is much lower today. We're at 6% mortgage rates. So to me, it's always going to be the labor market first. The mortgage spreads can get better over time. They've gotten a little bit weaker the last few days, but those things it doesn't take much, just a little bit nudge just to get down to that level. But again, having it stick really means that Fed policy is going to have to be probably a little bit more dovish or the labor market breaks. See, the Fed policy, I've always tried to stress this to everyone. We are still in tight policy for housing, right? Because we do need that mortgage rate to grow sales. But the labor data really is the key because that's the only thing that made mortgage rates go from 7.5% down to near 6% again. It wasn't the Fed rate cut, right? We had almost a 2% move lower in rates without any rate cuts. But because housing starts beat, because retail sales beat, industrial productions beat, the labor data has gone better, bond yields have gone up because the Fed, basically, that's where policy is. So it's not shocking that yields went up. But for me to get down to that low level, we do need those variables to kick in out there. And it's one of the unfortunate things about the housing market is that you do need an economy to get softer for rates to go lower. But we're not that far off, right? I know there's a lot of people that said mortgage rates have to get down to 3 or 4% to grow sales. We've disproven that, but it does need to get, kind of that. If you could get rates below 6% for an entire year, if you could get rates below 6% for the 12 months, you got sales growing. And because we have so many people waiting, right, the time for that to happen, you could actually get a little bit of an extra kick just because people have been on the sidelines. But that 4 million core buyer has been there. That 4 million core buyer in the existing home sales market has not left. And of course, new home sales are growing. It grows a little bit faster when rates get down to 6%. So it's encouraging, but considering what I've seen in 2022, 2023, and 2024, it's a valid model now, right? We have enough data to show this, that you don't need 3 to 4% mortgage rates to grow sales from these levels. Maybe if you get down up to 4.75 million and something like that, if sales grow, then that's a different story. But from where we are today, we can do this.
Speaking of the economic data, it seems like sometimes when jobless claim numbers are released, sometimes there's like retroactive variability, like they'll revise them a little upward or a little downward for previous months. Does that have an impact on the outlook at all?
Yeah, I mean, for my work, I was always looking for the labor data to come in between 140 to 165,000 job gains per month. I was wrong for a very long time. But of course, anybody who tracks data knows you get revisions on labor data all the time. So the revisions have actually got the labor data to my model now where, okay, this is where we should be. And any more negative revisions on any of the data line draws that number below that 140K. That, to me, I always think the Fed does not feel comfortable with, They'll be completely happy with 140 to 165,000 jobs created for the next 10 years if they could pull that off. But here, because the last 2 months had negative manufacturing, because construction jobs were slowing down, they kind of understand why they needed to get rates a little bit lower. So I'm not worried about rates shooting back up to 8% or anything like that. But we're just talking about existing home sales. And because of that, maybe the revisions down the line would actually make things a little bit easier because we don't need much. 20 or 30 basis points in yields and a little bit better spreads, and you can get there. It's just the sticking down there at that part. That's the hard one, because whenever we get down here in rates just shoot right back up. Happens every time. And a lot of that is policy. Policy is still, the Fed will tell you right now, our policy is still restrictive. I know. I talk about that all the time. But in this context, to grow sales, maybe those revisions help down the line. But I think the number one key is if jobless claims were authentically breaking, like we saw in the data line today, if it looked like that without any hurricanes, the 10-year yield goes lower. Mortgage rates go lower. They're not going to wait for the Federal Reserve. They didn't wait for the Federal Reserve when we went from 470 all the way down to 360. They probably overdid it, but in that context, the labor data led the bond market. It leads mortgage rates down. And then, of course, we had a series of data that improved recently. So it's a tug of war, but it's a tug of war that isn't that far off from getting the ability to grow sales again.
Mm-hmm. Sure. Well, always appreciate the overview, but there also has been reasonably significant developments when it comes to post-storm recovery. Obviously, our thoughts are with everyone impacted by the landfall of Hurricane Milton, but that is a very recent development over the past 24 hours when we're having this conversation. You spoke about the post-disaster climate previously, but what additional color does the more recent events place on things?
So whenever we think of a hurricane, always kind of think about, remember the first few weeks of COVID. In the first few weeks of COVID, everything stopped. People stopped listing their homes. People took transactions off. Nothing was going on. That's going to be the immediate impact of a hurricane in these areas, that, transactions can't get done because nobody knows the insurance has to go in there and take a look. People are going to take their homes out of the market to kind of get a scope. And it really just destroys the equilibrium of how buyers and sellers work. And that's what we should expect until we get a little bit more clarity on what the damage is, what the costs are, what are the new insurance rates, or do you even get insurance? This is why a hurricane impact like this now is a little bit different than, let's say, 2 decades ago, where you knew you were covered, you could afford the coverage, and it wasn't an issue. Once you get this thing started, okay, we start fixing, rebuilding, and then you go. But now you're just not sure. You're not sure if every insurance company is going to leave this area. You're not sure what the costs are. So it throws a wrench in the whole buying and selling process. And you're just going to have to wait until more clarity of information goes on, and then you can move on from that. And that's not a housing economic normal thing. That's just, that's an act of nature, and this is how nature could be very destructive to economics, that it could just basically stall out a process until more clarity is given.
Certainly. Well, Logan, I think we went around the world a little bit. Is there anything that I'm missing? Is there anything that you think that people who listen to the show on a regular basis need to take to heart?
Just the one interesting aspect about the hurricanes and rates going up is to kind of see how the new listings data starts to react. By the time this podcast is out, the information would be already out there. New listings data is already in its seasonal decline already, but does the higher rates and the hurricanes make that number drop a little bit more? It should, in the sense, because you can't, people aren't going to list their homes if they in a hurricane zone. And if that occurs, we're going to have to figure out how much of it is just the rate aspect, or how much of it is the hurricane aspect, because there's only just a few areas of the U.S. where that'll be affected. But that's the thing I'm going to look out, because I've been so happy about the inventory growth in 2024, and I kind of want to keep that continuing. But we're also starting to get into the seasonal time frame where that starts to decline, and do people just say, "Hey, listen, I'm just going to wait till next year in the spring," and that's why we like to track the live weekly data.
Certainly. Well, hey, Logan, thank you very much as always. Much appreciated.
Pleasure to be here.